Right now, Bitfarms Ltd is trading at $4.20 per share, up about 0.72% on the day. Now, seeing a sub 1% move in a Bitcoin miner might seem unremarkable, almost boring. The common expectation is that these stocks are just leveraged instruments on the price of Bitcoin. BTC goes up 5%, miners go up 15%. BTC drops 5%, miners plummet 20%. That's the simple story most people who engage in online investing tell themselves. But that expectation completely misses the intense operational reality happening under the hood. The real story today isn't about the price of Bitcoin, it's about the brutal war of efficiency being waged in the mining sector post-halving, and the market is only just beginning to price in the difference between the survivors and the casualties. What we're seeing with Bitfarms is a subtle but critical divergence, a signal that its strategic focus on low-cost power and fleet modernization is creating a tangible competitive moat that the headline chasers are overlooking. Most investors, whether they're using a sophisticated interactive brokers platform or a straightforward Robinhood app, lump all miners together. They see a ticker like BITF and think, okay, this is my high beta crypto play. They buy it expecting a magnified ride on Bitcoin's coattails. This is the prevailing narrative, and for a long time, it was mostly true. But the April 2024 Bitcoin halving changed the fundamental economics of this industry forever. The block reward, the amount of new Bitcoin awarded to miners for validating a block of transactions, was slashed in half. Overnight, the revenue per unit of computational work was cut by 50%. The expectation was simple, a culling of the herd. Miners with high energy costs or older, less efficient machines were expected to become unprofitable and shut down, capitulating and selling their Bitcoin reserves, creating a downward spiral. The reality, however, is far more nuanced. It created a stark dividing line between miners who had prepared and those who had not. Bitfarms, with its aggressive fleet upgrade and strategic expansion into low-cost energy jurisdictions like Paraguay, had been preparing for this moment for years. The current stock price action, while seemingly quiet, reflects this new dynamic. It's not about wild speculation anymore, it's about industrial-scale operational excellence. Let's dissect the recent trading activity. The low volatility we see today, that minor 0.72% gain, comes on the back of a period of significant fluctuation for the entire crypto mining sector. Following the halving, we saw immense selling pressure on many mining stocks as the market tried to figure out who would survive. Trading volumes across the sector were massive. Bitfarms was no exception, experiencing daily swings that would make an investor in Apple stock feel nauseous. Yet, in the weeks since, a pattern has emerged. On days when Bitcoin shows strength, Bitfarms has captured that upside effectively. But more importantly, on days when Bitcoin is flat or pulls back slightly, Bitfarms has shown relative strength, finding a floor more quickly than some of its peers. This suggests that a new class of investor is entering the space. They aren't just speculators, they are looking at production reports, at the exahash per second growth, and most critically, at the all-in cost to mine a single Bitcoin. This is the kind of deep analysis that sophisticated users of Fidelity or SoFi Invest platforms perform, looking beyond the surface-level correlation to Bitcoin. They are starting to value Bitfarms not as a crypto proxy, but as an energy and technology company that produces a digital commodity. Institutional activity further supports this shift. While retail traders on Robinhood might be chasing momentum, recent filings show a calculated interest from larger funds. Of course, you see passive index fund ownership, but the interesting part is the active managers who are building positions. They aren't buying the sector, they are selectively buying specific companies. They understand that a miner with a power cost of 4 cents per kilowatt hour is a fundamentally different business from one paying 7 cents. Bitfarms' focus on hydropower in Quebec and now Paraguay is its ace in the hole. This isn't just a greenwashing PR move, it's a core economic strategy. Hydropower provides a stable, predictable, and, most importantly, cheap energy source, insulating them from the volatile price swings of natural gas that can cripple miners in other regions. This is the kind of durable competitive advantage that long-term investors, whether they're managing Fidelity mutual funds or their own individual brokerage account, are looking for. They are betting that as the global hash rate continues to climb and mining difficulty adjusts upward, only the miners with the absolute lowest cost of production will thrive. So, what does Bitfarms actually do? In simple terms, they run massive data centers filled with specialized computers called ASICs. These computers work around the clock to solve complex puzzles, and in doing so, they process and secure transactions on the Bitcoin network. For this service, they are rewarded with Bitcoin. The business model is brutally simple. Revenue is the market value of the Bitcoin they mine, and their primary expenses are electricity and the depreciation of their mining fleet. The game is to maximize the amount of Bitcoin mined while minimizing the cost of electricity. This is where their strategy comes into focus. The company has been methodically retiring its older, less efficient mining rigs and replacing them with the latest generation hardware. This upgrade accomplishes two things. It dramatically increases their hash rate, their total computational power and share of the global mining network, and it improves their energy efficiency, meaning they use less electricity to mine each Bitcoin. Their expansion into Paraguay is the next chapter of this strategy, aiming to tap into some of the cheapest hydroelectric power in the world. This isn't a short-term trade, it's a long-term capital allocation decision designed to secure their position on the lowest end of the global cost curve. This is the kind of strategic thinking you'd expect from a blue-chip industrial company, not a volatile crypto-related stock, and it's what separates a serious investment from a mere gamble. Looking toward the future, the landscape is fraught with immense opportunity and significant risk. The primary catalyst, of course, remains the price of Bitcoin. If we see a new bull market that takes Bitcoin to new all-time highs, the operating leverage for an efficient miner like Bitfarms is astronomical. Their revenue would soar while their primary cost, electricity, remains relatively fixed, leading to a massive expansion of their profit margins. This is the scenario that excites everyone, from the user managing a Schwab Intelligent Portfolios account to the day trader using the Fidelity mobile app. Another major catalyst is industry consolidation. As the post-halving pressure continues to squeeze less efficient miners, we could see a wave of mergers and acquisitions. Bitfarms, with a relatively strong balance sheet and a clear operational strategy, could be a prime candidate to acquire distressed assets, further increasing its market share at a discount. Comment below if you think Bitfarms' expansion into Paraguay gives them a long-term competitive advantage in energy costs. However, the risks are just as real. A prolonged bear market in Bitcoin would be devastating. Even the most efficient miners can't escape the gravity of a falling commodity price. Regulatory risk is another constant threat. While jurisdictions like Quebec and Paraguay are currently friendly, a shift in political winds could jeopardize their core operations. Finally, there's execution risk. Their expansion plans are ambitious. Delays in construction, issues with power agreements, or problems procuring new mining rigs could all hinder their growth targets, causing the market to reevaluate their prospects. These are the variables that investors need to watch closely, whether they're using SoFi ETFs for broad exposure or making concentrated bets on single stocks. The world of online investing has made it easy to buy shares, but the real work is in understanding these underlying dynamics. It's not as simple as watching the ticker for Tesla stock or Nvidia stock. This sector requires a different level of scrutiny. In conclusion, the market's general expectation of Bitfarms is that it's a simple, leveraged bet on Bitcoin. It's a story that's easy to understand and trade. The deeper reality, however, is that Bitfarms is an industrial-scale energy arbitrage and technology company navigating a highly competitive global landscape. The recent stock action, characterized by relative strength and consolidation, suggests that the market is slowly waking up to this reality. The narrative is shifting from pure speculation to a more grounded analysis of operational efficiency, energy costs, and strategic fleet management. The post-halving environment has separated the wheat from the chaff, and Bitfarms is positioning itself to be the former. While its fate is undoubtedly tied to the future of Bitcoin, its success or failure will ultimately be determined by its own operational execution. The simple expectation is a ride on a rocket. The complex reality is